Welcome to the latest Motley Fool scoreboard. I'm Anand Chokkavelu, and we've got longtime fools, Matt Frankel and Jason Hall, giving a 1 to 10 rating to the company that gives you dividends as often as you pay for housing. It's Realty Income, ticker symbol O. Talk about the business first, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Jason's at an 8. Matt, this is one of your favorite stocks, and you're at a 9.
Yeah, it's actually the first real estate stock I ever bought. I've owned it for, I think, 12 years now. Just let it compound over time. It actually has a trademark on the phrase, the Monthly Dividend Company. In the net lease real estate market, which is the type of properties they have, just kind of one sentence description, this is where tenants agree to pay insurance, property taxes, and most maintenance items instead of the landlord paying it like you would with a residential lease. It's a very fragmented market. But Realty Income is the largest player there. They have about 15,500 properties, most of which are retail, but most of which are not vulnerable to e-commerce or recessions. Think like dollar stores, warehouse clubs, like BJ's Wholesale is a big tenant of theirs. It's a big opportunity, bigger than you would think. There are over $5 trillion of net lease properties in the United States alone, and another 8 trillion in Europe where they operate as well. So it's a big opportunity.
Yeah, I can't really add much to what Matt said, but that's never stopped me from trying anyway. I think it's important to remember that because of its scale, you get a lot of benefits of cost of capital. It's viewed as a very safe borrower. And you see on Matt's screen there, the source of all of the background noise that he's having there. But there's also, as we're seeing, Matt, as they've expanded into some other experiential net lease, there's a little bit of hard to replace assets that they've added to their base as well. And the big one for me is its tenants have to have those properties because it's where their revenues come through. And having tenants that they count on those properties and also they're pretty resilient across the economic environment, I think is really good. And again, like you said, a lot of room to continue to consolidate that it might seem at the size of the business.
Yeah, you live right near the casino they just bought, I believe.
Yeah, Encore in Boston.
Let's talk about management next. A 10 is Warren Buffett. A 1 is Homer Simpson. Once again, Jason's at an 8, and Matt Frankel will not be oversold. A 9.
So, I mean, I would give this a 9, probably whoever was in charge. It's a business that at this point, it doesn't really matter that much who's in the CEO role. This is a steady compounder. It's built as a self-sustaining compounding machine. As Warren Buffett says, a ham sandwich could be running this company and it would be doing just fine. But their current CEO has been doing a good job. I mentioned the casino property they bought. He's done a really good job of diversifying into other property types. They're still about 80% retail in nature. But casinos, they have agricultural properties. They own a big vineyard. They own, they just partnered with Digital Realty, which is another one of my favorite stocks, to develop data center properties, which will be a brand new property type for them. So I like the diversification. They moved into Europe in the past few years, so geographical diversification as well. And that if you Google the ticker symbol ONL or look at a quote for that, that was their office properties that they spun off. That couldn't have come at a better time, right before the whole work from home wave. And so, I mean, smart management decisions.
Yeah, one of the things too, you mentioned Digital Realty Trust. As they've moved into some other verticals, they tend to partner where they don't have expertise. And I think that's real value additive, because where you see value destruction with these sorts of businesses is when they start to swim in waters they're not familiar with and they don't know there are sharks there, right? So I think that's smart that they've done that. My only quibble, the reason I came in as an 8, and I don't know that I should hold management too accountable for this, but the business has levered up a lot to grow over the past 15 years. And a lot of tailwinds from low interest rates. Dividend growth has slowed a lot already, so that we could see further pressure as the business has to refinance debt. I'll talk more about that in our next segment.
We'll talk about that in financials. A 10 is a fortress. A 1 is yikes. Jason said an 8.5. He's warming up here, and Matt's still at a 9.
Yeah, so going a little lower because the leverage ratios are generally healthy and they've actually improved over the past decade. The risk that we're running into now is because the way corporate debt works, you're not amortizing and paying off the debt over the term. You have to refinance it when it matures. And like I said, we've already seen dividend growth slow. And as it begins to refinance debt at higher rates, that raises the threshold both for new debt that it takes on, for new investments to get better rates of return. And so we're talking about headwinds for dividend growth and also for funds from operations growth. I think they can continue to deliver, but it's definitely makes it a little more challenging environment.
Yeah, and I mean, to kind of piggyback on that, the debt load is completely reasonable for a REIT of its size.
Yeah, I agree.
Of the two real estate companies we're talking about on the day we're recording this, it has the lower debt to EBITDA ratio, and a better cost of capital, much better cost of capital than its peers. The company just authorized a $2 billion buyback, and in the 12 years I've been a shareholder, that they haven't done that. So they clearly think that the stock is cheap right now. It's a very rate sensitive stock, so it's presumably to take advantage of the discount while interest rates are high. The stock's about 25% off of its all-time high. I mean, I don't know of any other company in the market that has consistently raised its dividend as much as Realty Income. Over 120 dividend increases since its 1994 IPO, steady FFO growth. I've covered this company on our earnings show before, and it could be a 5-second presentation. How was Realty Income's earnings? Good. Like they just, it's every quarter. It's just good. And they, like I said, they have a superior cost of capital, and it runs like clockwork.
How's the weather in Phoenix? It's good. Let's
Right.
talk about valuation, Jason. How well will Realty Income stock do over the next 5 years? How safe is it? 10's a sure thing, 1's a lottery ticket.
So my safety score is an 8. I think just like clockwork, we're going to continue to see solid performance, and the chance of losing money over a 5+ year hold is extremely, extremely low with this business. I'm expecting 5 to 10% of returns, probably on the higher end. That's roughly what the stock has generated over the past decade. I think we're probably going to see something similar. The dividend yield now, I believe, is a little over 5%. So you're already halfway there. All you need is a little bit of growth on top of that, growing FFO per share at just a little bit of a higher rate through a healthy economic environment and consolidation and those share buybacks. And that's before we even talk about, Matt, I'll leave it in there for you to talk about potential multiple expansion if interest rates come down.
Yeah, that's kind of where I said 10 to 15%. And the reason is over time, I expect this to generally be a market perform stock. It's going to compound my money at about 10% over the long term with lower volatility than the overall stock market, which is why I really love this stock. Over the next 5 years, I said 10 to 15% because this is a rate sensitive company. So it could get a nice tailwind. It could take another year before the Fed starts lowering rates, given what's going on right now. But over the next 5 years, I really see the trajectory for interest rates being downward. And I think that could provide a very nice tailwind for the stock.
And for those who love dividends, assuming that it's safe, which it sounds like it is, dividends over 5%. So that gives you a nice floor for those returns. Well, I guess not a floor because you could, if the stock just completely tanks. But again, this is a steady thing. I'm talking my book now because if you're doing the math, I'm about to own this stock. So let's talk about Top It, Jason. Is there a company in Realty Income space that you like better that, hey, maybe I should be buying as well?
So there are other REITs that I like better right now. But again, REITs covers a wide variety of different types of property types and different vertical markets. If you look at net lease REITs, it's my top pick. And like Matt, I do think it's very reasonably priced right now.
Yeah, it's definitely my top pick. It's one that I've probably added to more than any other stock I've owned in not just including dividend reinvestment. But I will say another net lease REIT that I own right now that looks attractive is Vici Properties. They're generally known as the casino REIT, and that's one that's similarly is just beaten down by interest rates.
Thank you to both Matt and to Jason. They've given Realty Income an overall score of 8.0 out of 10, which I talked about. Means that I'm buying at least $1,000 worth and holding for at least 5 years. So Matt's first real estate stock will be my latest. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Sun Communities. That's the one Matt was comparing to Realty Income. Till then, Fool on.
They are, yeah, they're right there. They're
That's so hilarious.